Hi, and welcome to the 2023 first quarter investment update from San Diego Foundation. I'm Matt Fettig, Chief Investment Officer at the Foundation. After a tumultuous 2022, markets recovered in the first quarter of 2023. 2022 was really a story of inflation and the Federal Reserve raising interest rates in an unprecedented fashion to combat that inflation. In 2023, we learned that inflation was peaking, perhaps falling in some areas, and as a result, the Fed signaled that it may be done with interest rate increases. The result was a strong equity market, really led by international equities and U.S. equities, followed by emerging market stocks. In addition, bond yields returned to a level we haven't seen in a number of years, and bonds offered fairly strong results as well. Let's start by talking about the endowment portfolio. The endowment portfolio was up 3.6%, outpacing its policy index, up 3.2% for the first quarter of 2023. For the year ending March 31st, the portfolio was off 3.5%, largely due to the impact of results in 2022, but well ahead of its policy index, down 6.3%. So during the first quarter, both stocks and bonds rebounded strong after a tough 2022. Unfortunately, the private markets, including private equity, private credit, private real estate, saw some lag in repricing assets down, and therefore were a drag on the performance of the portfolio. In addition, hedge funds, and keep in mind in 2022, this portfolio's hedge funds produced a slightly positive rate of return overall, were also a drag as the market turned around and stocks rallied through the end of the first quarter. The long-term portfolio slightly lagged its policy benchmark for the 3-month period ending March 2023, but produced a 4% rate of return. The portfolio was down 4.9% for the 1-year period, ahead of its benchmark, and is also equal to or ahead of its benchmark over the 3, 5, 7, and 10-year periods. A rapid rebound in the global equity and fixed income markets helped this portfolio quite a bit during the first quarter. However, the fund's allocation to hedge funds, which makes up a fairly sizable amount of the portfolio, lagged during the first quarter. However, keep in mind these hedge funds protected capital significantly in 2022 when both stocks and bonds were down, and therefore provide great correlation benefits for the portfolio. The medium-term portfolio, remember, consists 70% of fixed income or bonds, 25% stocks, and 5% real assets. 2022, with interest rates increasing dramatically due to the Fed raising short-term interest rates, was a big headwind for this portfolio as bond prices fell. Here in 2023 to date, the portfolio's 25% exposure to stocks did quite well, and we did see quite a dramatic rebound in both short-term and medium-term fixed income assets, leading to a robust return for the quarter. The intermediate-term portfolio was up 3% for the first quarter, outpacing its policy index of 2.4%. While it was down for the 1-year period, down 1.8%, it was also ahead of its policy index, which was down 2.7%. So remember, this portfolio consists 100% of fixed income assets, both short-term and medium-term fixed income assets. And after a difficult 2022, one in which short-term interest rates increased dramatically, this portfolio is now offering a decent amount of yield and also saw some price appreciation for the quarter. And finally, the short-term portfolio consists 100% of money market funds. Money market funds are highly correlated to short-term interest rates in the U.S. So as you might guess, as the Federal Reserve increased interest rates, the yield on money market funds increased as well. At the end of the quarter, the yield on this portfolio was about 4.7%. So after years of effectively yielding zero with short-term interest rates at zero, this portfolio now offers a decent amount of yield to donors. Let's switch gears and talk about our two sustainable portfolios, both the Sustainable Endowment portfolio and the Sustainable Non-Endowment portfolio. Keep in mind, both of these portfolios are positioned exactly the same way, so I'll cover them both at once. The Sustainable Endowment and Non-Endowment portfolio was up about 3.8% for the first quarter, trailing its policy index up 6%. The portfolio had a very difficult year in 2022, as if you really dissect the stock market, the only sector within the S&P that was up in 2022 was energy, and this portfolio divests from fossil fuels. Energy was up over 60 to 70%. The next best sector was about flat. So just by divesting from that fossil fuel market, this portfolio lags significantly behind. You can see for the longer time period, the 1-year number that's reflected, but over the 3-year time period, the portfolio is still outpacing its policy index. Thanks so much for joining. If you need more information, you can find it at our website, www.sdfoundation.org. Thanks.